Hello students, I am Dr. Panduranga Nayak, Principal Swiss College Bantwal. Today I am interacting with you on the topic Final Accounts of Non-Trading Concern, video number 4. At the end of the previous video, I was telling you the importance of differentiating between capital items and revenue items. If proper distinction is not made between capital items and revenue items, then the surplus shown by the income and expenditure account will not be proper. Similarly, balance sheet of the non-trading concern will not reflect the correct financial position of the non-trading concern. Now, before going ahead, now we have to understand how to classify these business transactions. So there are two classification or categorization. One is capital items, the other one is revenue items. The main capital items are capital receipts and capital expenditure. And the main revenue items include revenue receipts and revenue expenditure. Okay. Now we'll begin with capital receipts. What are capital receipts? Capital receipt is the receipt, the amount actually received on account of capital item. Say, capital introduced into the business by the owners, sale proceeds of fixed asset or investment, etc. So, capital receipt is the amount actually received on account of capital item. Example, capital introduced into the business by the owners, sale proceeds of fixed asset or investments, etc. Even the amount received in the form of loan or fixed deposits. So these are items of capital nature. These are called capital receipts. Let us look into the features of capital receipts. Capital receipts are of non-recurring nature. That is, they are not received regularly. They are received once in a way. So they are not occur very often. Unlike in the case of revenue receipts. Revenue receipts recur. Very often you receive. But this is non-recurring in nature. Normally the amount involved is huge. Similarly, they will appear in the balance sheet. They will not be taken to the income and expenditure account. They will be taken to the balance sheet. Let us look at some of the examples of capital receipts. Capital received from the proprietor of the business. This is in the case of trading concern, but in the case of non-trading concern, any amount received from the members which are of capital nature. So capital received from the proprietors of the business, that is an item of capital receipt. Here the explanation is in general whether the concern is trading or non-trading. Amount received by way of loans, because you don't receive the loans very often unless they are short-term loans. So long-term loans received are non-recurring in nature. Amount received by way of loans. Amount received by way of deposit. Similarly, when you sell the investments, whatever amount you receive, that is also an example for capital receipt. Sale proceeds of investments. Sale proceeds of any fixed asset like land, building, machinery, motor vehicle, furniture, etc. Then non-recurring receipts like life membership fees. So life membership fees is paid by any member only once in the lifetime. So that is non-recurring in nature. Legacies. Legacies means the gift or donations received from a person under his will after his death. So that will be received after his death as per the will of the member. So that is called legacy. So that is also non-recurring in nature, and therefore that will not come to the income and expenditure account, rather it will be taken to the balance sheet. Okay, these are some of the examples of capital receipts. So capital received from the proprietor of the business, amount received by of loans, amount received by of deposits, sale proceeds of investments, sale proceeds of fixed assets, and non-recurring receipts like life membership fees, legacies, and then donations, etc. Big donations. Okay. What is the treatment of capital receipt? There are two things. One is that will be shown as a liability. For example, deposits received from somebody, that will be shown as a liability on the liability side of the balance sheet. Similarly, any loan received or loan taken from somebody, so amount received by way of loans, that's also shown as a liability. That's one part. But some capital receipts will be shown as deduction from the assets. Just see, capital receipts from the sale of investments and fixed assets are not shown on the liability side, but are deducted from the concerned asset on the asset side of the balance sheet. While deducting capital receipts from investments and fixed assets, it must be noted that only the book values of the investments and fixed assets should be deducted from the investments and fixed assets, not the actual sale proceeds. So this is about capital receipts. So capital receipts are receipts of capital nature. They are not recurring in nature, and moreover, normally the amount involved is huge or for some specific purpose, and they will appear on the balance sheet either on the liability side or as deduction from the assets. So that's about capital receipts. Now we'll move on to revenue receipts. So revenue receipts are the receipts which are revenue in nature. So revenue receipt is the receipt on account of a revenue item, say sale proceeds of goods, any income received, etc. Features of revenue receipts. Revenue receipts are recurring in nature. They take place very often. They are repetitive in nature. So they are received regularly or repeatedly. For example, rent, if any asset is let out, say building is let out, so rent is being received every month. Okay, so thus they are repetitive in nature. For example, interest received on loans granted, so repetitive in nature. Interest received on investments, so they are repetitive in nature. They are regularly received. They are generally small in amount. They will appear in the profit and loss account or income and expenditure account. In the case of trading concern, they will appear in the profit and loss account, and in the case of non-trading concern, the item will appear on the in the income and expenditure account. Okay, let us see the examples of revenue receipts. Sale proceeds of goods. So sales are taking place very often. That is recurring in nature. Every now and then sales may happen or take place, and therefore that's an example for revenue receipt. Interest received on loans granted. So the interest on loan is normally received either monthly or half yearly or at least on an year. Therefore, it is regularly received. Interest received on bank deposits. Okay, like the previous item, even here it is received regularly. Rent received. Rent is also received every month, and therefore revenue in nature. Commission received, that's also received regularly. Dividend received on shares held as investments. Okay, either interim dividend or final dividend. Anyway, it is received within a year. Sale proceeds of old newspapers, sale proceeds of old packing cases, sale proceeds of old sports materials like old bats, old balls or old nets, etc. So these are the examples for revenue receipts. Okay, how revenue receipt will be shown in the final accounts of non-trading concern? Okay, revenue receipts will appear in the revenue account, that is income and expenditure account in the case of non-trading concern. So all these items will come to the credit side of income and expenditure account, whereas capital receipts will be shown in the balance sheet either as a liability or as a deduction from assets or investments. Normally, if an income is received within a year, then it is taken as a revenue receipt. If it is received after 1 year or for a longer period, and if it does not recur, then that will be taken as capital receipt. So proper differentiation between revenue receipt and capital receipt is very, very essential. Otherwise, final accounts of non-trading concerns will not reflect the correct or the true profits, true surplus for the accounting year. And similarly, the balance sheet will not show the correct financial position of the non-trading concern. So in the next video, we are going to study what is meant by capital expenditure and revenue expenditure, and also we are going to study further deferred revenue expenditure. Thank you for listening to this presentation. Thank you.